Most people believe that making money in the stock market means trading every day, watching charts, timing the market, buying and selling non-stop. But here's the truth most people never realize. The biggest wealth in America wasn't built loudly. It wasn't built with alerts, indicators, or breaking news. It was built silently. While millions of people chase quick profits, a small group of investors quietly let time do the work. No stress, no noise, just patience. Look closely at the people who've built real, lasting wealth in the United States. They don't trade more, they hold longer. Even legends like Warren Buffett have repeated the same message for decades. You don't need to be smart every day. You need to be consistent for years. This is where ETFs come in. ETFs aren't exciting. They don't promise overnight riches. They don't make headlines. But they do something far more powerful. They quietly compound wealth while most people are distracted. In this video, we're not talking about hot stock tips or risky trades. We're revealing the silent wealth system that millions of Americans rely on to grow money, protect their future, and build financial peace. If you're tired of noise and ready to understand how real wealth is built, this video is for you. Lesson 1. Why smart money doesn't trade. Smart money doesn't trade every day, and there's a reason for that. Most people think frequent trading means intelligence. In reality, it usually means impatience. Every time you trade, you fight three enemies at once: emotions, costs, and uncertainty. Markets move on news, fear, hype, and speculation. Short-term prices are noisy and unpredictable. Smart money understands this and stays away from the noise. Instead of reacting to every headline, smart investors focus on one thing: time. They know that wealth isn't created by predicting tomorrow. It's created by participating in long-term growth. History shows a simple pattern. The more often people trade, the worse their results become. Taxes eat returns. Fees compound negatively. Emotions force bad decisions. That's why institutions, pension funds, and experienced investors trade less, not more. Even legendary investors like Warren Buffett have been clear about this. The stock market is a device for transferring money from the impatient to the patient. Smart money doesn't try to outsmart the market every day. It owns the market. While others chase fast profits, smart investors let compounding work quietly in the background. They don't trade for excitement. They invest for results. And that mindset is the foundation of silent wealth. Lesson 2: ETFs. The silent wealth machine. ETFs were never designed to impress. They were designed to work. An ETF, or exchange-traded fund, is a simple idea with powerful results. Instead of betting on one company, you own a basket of many, sometimes hundreds or even thousands, through a single investment. This is why ETFs are called silent wealth builders. They remove the pressure of choosing the perfect stock. They reduce risk through diversification, and they allow your money to grow with the overall economy, not individual hype. In the United States, most long-term wealth is built by participating in the market, not trying to beat it. ETFs make that participation effortless. As companies grow, innovate, and generate profits, ETFs quietly capture that progress. No constant monitoring, no emotional decisions, no daily noise. This is why ETFs are the foundation of retirement plans, pension funds, and institutional portfolios. They are trusted not because they are exciting, but because they are reliable. ETFs reward patience. They reward discipline. And most importantly, they reward time. While others search for shortcuts, ETFs follow a simple path: steady growth compounded over years. That is why ETFs don't create headlines. They create wealth. Silently. Lesson 3. Time is the real asset. Most people believe money is the most important factor in investing. But smart investors know the truth. Time matters more than money. You can start with a small amount, but if you give it enough time, it can grow into something powerful. This is where ETFs show their real strength. ETFs are not designed for speed. They are designed for endurance. When you stay invested year after year, something invisible begins to work in your favor: compounding. Your returns start generating returns of their own. Growth builds on growth. And over time, the curve bends upward. This is why long-term investors don't panic during market drops. They understand that short-term declines are the price paid for long-term progress. Instead of asking, "What happens this month?" they ask, "Where will this be in 20 years?" ETFs make this mindset easier to follow. They remove the temptation to constantly change direction. They encourage consistency. In a world addicted to speed, ETFs reward patience. In a market full of noise, they offer clarity. When you stop fighting time and start working with it, wealth stops being stressful. It becomes predictable. And that is the quiet power behind ETFs. They turn time into your strongest ally. Lesson 4: Why ETFs win. When emotions lose, the biggest enemy of investors is not the market, it's emotion. Fear and greed push people to make the worst decisions at the worst times. They buy when prices are high. They sell when prices fall. ETFs are powerful because they quietly protect investors from themselves. When you invest in individual stocks, emotions are constantly triggered. Every headline feels personal. Every dip feels dangerous. Every rally feels like a reason to chase. ETFs reduce this emotional pressure because you're not relying on one company, one CEO, or one quarterly result. You're relying on the long-term growth of an entire market or sector. This makes it easier to stay invested during uncertainty. And staying invested is what actually builds wealth. ETFs don't encourage reaction. They encourage consistency. Instead of asking, "Should I sell now?" ETF investors ask, "Am I still invested?" That simple shift removes panic from the process. Over time, this emotional discipline becomes a massive advantage. While others jump in and out, ETF investors stay the course. And in the stock market, staying the course is often more important than being right. ETFs don't eliminate risk. They manage it. They don't promise excitement. They deliver stability. In a market driven by emotion, ETFs quietly reward calm.